Hi, I'm Jimmy. In this video, we're going to look at the current strength of the US economy. We're using different economic indicators to see if we can fairly gauge where the economy stands today and hopefully answer the question, should we invest now or wait for the stock market to crash again? Okay, so let's jump right in. So I think it makes the most sense for us to start with the consumer, since the consumer is one of the largest drivers of the US economy. So first, we've got consumer confidence. And in my mind, this chart looks to be telling me that this is going to be a point for the bears right now, since it appears that recently consumer confidence has been more negative. Now, we keep waiting for this to bounce back so we had a pullback when COVID happened. That's logical. I keep waiting for a recovery, but that hasn't really happened as of yet. And I do suppose this makes some sense given the uncertainty right now with the broader economy. Either way, I think it makes sense to give this point to the bears. Now, I've seen a few comments on some older videos in this series saying that consumer confidence isn't that useful of an economic indicator. And they go on to say, just look at what happened in the financial crisis. The financial crisis really took off in about 2008. And they say, look how high consumer confidence still was at that point. And I could see how we might say that when we're looking at this long-term chart that has a lot of data in a very small amount of time. If we had done this same analysis, if we looked at the same chart in April of 2008, well, this is what the consumer confidence would have looked like back then. And clearly, this pullback, the big pullback in the most recent time period, would have been a cause for concern. And I'm fairly certain that we would have given this point to the bears at that time had we been doing this analysis. And if we're curious, well, this is what the S&P 500 had done over that same time period. And as we could see, well, the S&P 500 was still fairly high at that time. So consumer confidence was leading the way. And about 9 months later, well, when we update this chart, well, look at what happened to both consumer confidence and the S&P 500. The real turning point in my mind is that the S&P 500 really took a nosedive in the following 9 months after that. So it turns out that consumer confidence is a fairly reliable leading economic indicator. So over on our economic scorecard here, well, I think it makes sense to go ahead and give this point to the bears. Okay, now let's stick with the consumer, but now let's shift over to some consumer debt. And I actually think that this one's a fairly straightforward economic indicator. This is the percentage of household debt as it relates to GDP. And we can see that recently there was a big spike. Not quite as high as it got back during the financial crisis, but still much higher than it was. And I think that this is going to be an important one for us to watch as the economy recovers. I think that this one is going to be crucial. Does this get better or worse? So back to our scorecard. Again, another point for the bears. Okay, now we're shifting over to interest rates and we're looking at the yield curve. This is the Treasury yield curve as of a couple days ago. And basically what the Treasury yield curve does is it plots what the interest rate is at different time periods, how far out we're going. And this is exactly how a yield curve should look. It should be upward sloping like that. It would be a bad sign if it was an inverted yield curve. Inverted yield curves are when the short-term rates are paying a higher interest rate than long-term interest rate. But there's another angle to this whole thing that makes me question if this should in fact be a point for the bulls. Yes, it is upward sloping and that is a positive sign. It is not inverted, so that is a good thing. But look at what happens when we add the interest rate, same yield curve, but from last month. We could see that with the orange line, that was as of early February. Well, interest rates are a decent amount higher above last month's interest rates. And it is fairly unusual for interest rates to climb this much in such a short period of time. Now, there are a few reasons that this could be happening. The most popular theory out there right now is that this is happening because of inflation, or really fears of inflation, which would actually be a very logical reason to increase interest rates, and that would be a big problem for the economy. So this could be a negative sign, but it's not just as of yet. So we have a good sign, a normal yield curve, a bad sign, rapidly increasing interest rates. So with that in mind, back over on our scorecard here, well, I actually think it makes sense to make this one a neutral point, because here we give a point to the bulls because of the yield curve being normal, and a point to the bears because interest rates are shooting up somewhat quickly. Okay, now let's take a quick look at the job situation. So first up, we have initial jobless claims. And this is a weekly number, and as we can see, well, the current level is way too high compared to what initial jobless claims were before COVID. So pre-COVID compared to now, they're not even close. So we're going to need for that to get better. And this is going to be a point for the bears. Now, I am optimistic that as things open back up and more people get vaccinated, well, it's very possible that this begins to normalize to pre-COVID levels. But for now, a point for the bears. Okay, so now we switch over to unemployment. So unemployment clearly had a bad jump when the coronavirus happened. And it's actually been recovering a decent amount since then. So I personally actually have unemployment as a neutral point. Yes, it is too high right now, but it is rapidly heading in the right direction. So I think it's fair right now to give this a neutral point. Now, just to clarify one point real quick, I've actually gotten a few comments on some of my other videos where people say unemployment is a garbage number and we shouldn't use it. And that's because ultimately the U3 unemployment rate, which is what I use, well, they say that this, and this is true, that you only count in the U3 unemployment rate if you're unemployed and actively seeking work. And it's a very fair criticism that this isn't the greatest calculation of unemployment. It doesn't count you if you're underemployed or if you get frustrated and you stop working. And this is a very fair criticism. But this doesn't make unemployment a completely useless economic indicator. A better indicator in theory to use would be something known as the U6 unemployment rate. This economic indicator is much closer to the true situation for unemployment. So this accounts for people that are unemployed, underemployed, or even what they call discouraged workers. A discouraged worker is somebody who they want to work, but they get frustrated. Maybe they can't find a job after a while, they stop looking. Unemployment U3 wouldn't count them. U6 does count them. But the reason that I use the U3 number is one, the U3 unemployment number is by far the most popular number. If you ever see headlines about unemployment, it will be most likely the U3 number that they're looking at. But more importantly, since what we're looking for when we analyze a chart like this is we're looking for the trend. What is the overall situation? Are things getting better? Are they getting worse? And since that's what we're after, well, the U3 and the U6 are not terribly different. Just to illustrate, here's what happens when we overlay the U6 unemployment number. And sure, the orange line, which is U6, the more accurate number, well, we can see that it is consistently higher than the U3 number. But we can also see they move about the same. They move very similar to each other. So if what we're looking at is trend and how it is in relation to its own history, well, using either number, you should end up with a very, very similar conclusion. So hopefully that clears some of this up a bit. Okay, now back over to our economic scorecard. Well, now we got 3 points for the bears and 2 neutral points. So right now things are looking a little bit rough for the economy. But now we're going to switch over to housing. So our first one is the price of existing homes. And we can see that this economic indicator is gradually trending higher. Now, higher home prices isn't necessarily a surprise now that we have lower interest rates. So this is somewhat expected. Now, it's also been pointed out to me quite a few times that higher home prices makes it more difficult to buy a house, makes it more difficult to buy a house. And that is very true. Higher home prices, it is in fact more expensive, which in theory could be a negative sign. But the flip side of that is that if somebody's buying those houses, well, somebody's receiving that cash, and that in theory is a good sign. So it's not quite as clear cut as this is a positive sign or a negative sign. I suppose it depends on what our personal position is, whether or not we like the fact that housing prices are going up or housing prices are going down. But generally, historically speaking, when housing prices are trending higher, that tends to happen in stronger economies. Hence the reason I'm tying it to if housing prices are trending up, we're going to give it to a point to the bulls. But before we go over to the scorecard, let's take a peek at housing starts. So housing starts is the number of new houses being built. And we can see that once again, this is trending higher. Sure, there was a hiccup when COVID happened, but overall, I think we can all agree that the trend is in fact higher, which is again a stronger sign for the economy. So back to our economic scorecard here. Well, now those two are going to get 2 points for the bulls. So things are starting to even out just a little bit. But now let's shift over to manufacturing in the United States. So this is the ISM manufacturing indicator. And the most important level when we're reading this chart is 50. Anything above 50 is a positive sign for manufacturing because anything above 50 implies growth in the manufacturing sector. Anything below 50 implies negative growth in the manufacturing sector. So right now with this economic indicator at 60 or above 60, well, clearly this is going to be a point for the bulls because this is a positive sign. Okay, now before I jump over to the next economic indicator, each month we do this analysis, and a few times I've seen people comment and they say basically, hey, stop being so neutral about things. take a position and then stick with it. Don't just stay in the middle with this analysis. And when we look at this, well, I can safely say, yeah, I get what you're saying, but I'm really trying to stay as objective as possible. But this is actually one of the reasons that I do the scorecard, because you might look at this scorecard and you might say, you know what? I think housing prices going up is a bad sign. I don't think that's a point for the bulls. I think that's a point for the bears. Or maybe you look at, some other indicator and you think it should be swapped. Well, I'm hoping this scorecard does a good job of summarizing it, and feel free to swap things around as they may. Now, personally, I would love if all of these economic indicators got on one side or the other and made the analysis super clean and easy. If that happened, I would think that investing would be much easier. But these are some of the most popular economic indicators out there, and it just doesn't happen. It's just not that clear cut. Usually most things end up being in the gray area. So I apologize if it's coming off as I'm trying to hedge my bets and stay in the middle. That's really not what I'm trying to do. But either way, with that being said, let's take a peek at some credit card debt. So this is data put out by Equifax, and clearly this is a bad sign. This is the amount of people 90 days or more late on their credit cards payments. Now this data goes through the end of the fourth quarter of 2020. So it's not quite up to date for 2021, but still it gives us a good indication of what's happening. Now, where this could get really bad is I know that there's been some programs happening with the coronavirus and different stimulus that's been done that have allowed people to defer some of their credit card payments and mortgage payments, things like that. Well, when that goes away, do we see a significant jump in the number of people defaulting on their credit card debt? It's very possible, so I think this is going to be something we're going to want to watch closely. But either way, this is going to be a point for the bears. So now that we know that there are a few things holding the economy back right now, do we invest now or do we wait for the stock market to crash? Well, one of my personal favorite sayings is that time in the market is better than timing the market. So with that in mind, I'm actually a big fan of consistently investing using something like dollar cost averaging or trying to pick great buy and hold long-term investments. Now, it does seem to me that the stock market appears to be overvalued right now. Right now, the average PE for the stock market is about 32 times profit. So that's high. But personally, what I'm doing is I'm purposefully seeking out good investment opportunities that still appear to be undervalued in today's market. Just because the broader market is overvalued doesn't mean there's not individual opportunities. So as I'm building my personal investment portfolio, well, that is one of the ways that I'm doing it. Now, if you're curious what stocks I personally own, I recently did a video where I updated my personal investment portfolio. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.